Warren Buffett is known as one of the biggest optimists about the United States, yet right now he is quietly moving into a defensive position. For more than half a century, Warren Buffett has repeated a single famous line: never bet against America. In his annual letters to Berkshire Hathaway shareholders, he has described the United States as the best machine in human history for unleashing human potential and creating wealth. In his view, the American system of capital markets, entrepreneurship, and innovation is the foundation that has allowed the country to overcome crisis after crisis and come back even stronger. Exactly because of that, the fact that Buffett is now positioning himself defensively is a signal worth paying attention to. Berkshire Hathaway is holding the largest amount of cash and short-term United States Treasury bills in the history of the company. They now make up a very high share of total assets. In recent shareholder letters, he has spent more and more lines talking about what he calls fiscal folly and warning about scoundrels and promoters who took advantage of the era of free money and public greed to enrich themselves. Buffett almost never comments deeply on macroeconomics. His usual philosophy is simple: buy good businesses, hold them for a very long time, and do not waste your life trying to guess the business cycle. The fact that he now feels forced to speak up about debt, money printing, deficits, and undisciplined fiscal behavior shows that the problem has passed the normal range. In his way of thinking, a country is just like a business. It can grow revenue, but if interest expense explodes, if debt piles up, and if resources are burned on short-term goals, then intrinsic value is slowly eaten away. So what exactly is Buffett worried about when he looks at the American empire? The answer starts with the deepest chronic disease of every declining empire: addiction to debt, debt addiction, and reverse compound interest. One of Warren Buffett's most strict rules is to avoid dangerous leverage. He has said many times that debt does not only make you more likely to go bankrupt, it also steals your flexibility when real opportunities appear. At Berkshire, he intentionally keeps a lot of cash on hand and keeps debt low so that when others are forced to sell, he is the one with money ready to buy bargains. If he applied that thinking to a country, Buffett would ask three very simple questions. Is debt growing faster than income? How much of the budget is being eaten up by interest payments? And what are households and the government actually borrowing for? Do they borrow to invest in the future or just to keep their current lifestyle going? In the United States, all three answers are worrying. Federal government debt has jumped into the tens of trillions of dollars. Annual interest costs are moving toward around $1 trillion per year. That already takes up a very large share of the federal budget, and if the trend continues, it could even pass defense spending. At the level of a business, Buffett would say that interest expense has become a line item that is as large as the strategic investment budget. That is a classic sign of a company that is eating its future in order to feed its present. At the household level, things are not much better. Household debt from mortgages, credit cards, and student loans has reached new records. Even worse, a big share of this debt is not being used to build assets that generate cash flow, such as rental properties, factories, or real businesses. Instead, it is used to maintain a level of consumption, travel, shopping, entertainment, and an entire lifestyle built on installments. In Buffett world, compound interest is the miracle that creates wealth. If you let money grow at 10 to 15% a year for many decades, your assets explode upward. But in a country addicted to debt, compound interest also works only in reverse. Interest on a giant pile of debt makes the amount owed next year larger than this year. The budget gets sucked into interest payments, which forces the government to choose between three bad options. It can cut long-term investments in infrastructure, education, and research. It can raise taxes, or it can print more money. All three choices damage the long-term growth engine that Buffett sees as the soul of intrinsic value. Debt truly turns into a self-destructive weapon when it combines with a second trend: walking away from real productive assets and shifting to a model built on consumption and short-term finance. That is exactly what has happened to American industry over the past half-century. From factory of the world to consumer nation, if you think of the United States as a business, the productive sector made up of manufacturing, infrastructure, logistics, and energy is the core business that creates real value on a steady basis. This is exactly the type of asset that Warren Buffett loves: railroads, utilities, energy systems, and essential products that are tied to real daily needs of the population. Yet, over the past several decades, the United States has shifted away from being a producing nation toward being mainly a consumer and financial nation. Manufacturing jobs once accounted for close to 1/3 of all non-farm employment. Today, they are only a small single-digit share. The steel mills, textile plants, and auto factories that built the middle class in the Midwest and the South have shut down or moved away, leaving behind decaying towns across what people call the Rust Belt. In pure output terms, America still produces a lot of manufactured goods, thanks to much higher productivity. But the days when a stable manufacturing job could comfortably support a middle-class family have faded. As globalization opened up, many American companies took the easy option. They moved their production lines to China and other low-cost countries. The United States enjoyed cheap products, low inflation, and high profit margins for corporations. In exchange, it gave up a large part of its domestic industrial job base. For Buffett, that is a painful paradox. His own investment career is built on putting huge amounts of capital into railroads, energy, and utilities, the physical backbone of an economy. But the country where he lives has slowly stepped back from the role of factory and become more and more dependent on technology, finance, and consumption. In an economy like this, profits and jobs become more sensitive to swings in asset prices such as stocks, housing, and complex financial products. When capital flows reverse and bubbles deflate, the damage does not stay on computer screens. It goes straight into workers' paychecks and household balance sheets. As the industrial foundation weakens, the first people to get hurt are not tech billionaires. They are middle and lower income workers who once lived on factory wages and now have to take low-wage, unstable service jobs. From there, an even more dangerous problem starts to build up: rising inequality and the slow erosion of the American dream. Inequality and the erosion of the American dream. If you only look at gross domestic product or the stock market, the United States still appears extremely rich. But Buffett always asks a deeper question: who is actually enjoying this growth? Over the past few decades, the wealth of the top 1% has grown to about 1/3 of all household wealth in the United States. Meanwhile, median income, which represents the typical American, has risen only slowly once you adjust for inflation. Growth exists, but most of it has flowed toward the very top. Buffett is not outside that story. He belongs to the group that has won the most. Precisely because of that, he speaks very bluntly. He once said that there is a class war going on and that his class is winning. That was not a boast. It was a warning. When one side wins too easily, the system loses balance and the basic legitimacy of the social order starts to crumble. One of the clearest battlefields in that quiet class war is the tax system. Buffett has repeatedly pointed out a strange reality. The effective tax rate he pays as a billionaire whose income is mainly capital gains and dividends is lower than the rate paid by a secretary who lives on a salary. This led the White House to float a proposal called the Buffett Rule. People earning more than $1 million a year should not pay a lower tax rate than middle-class workers. The idea did not become law, but its very existence showed how serious the gap had become. At the same time, the most basic cost of living, housing, has shot out of reach for many regular workers. The median house price in America has increased many times over since the 1980s, while median income has inched up only slowly. For many young people, owning a home, a central milestone of the American dream, feels more and more distant. From Buffett's point of view, this is a systemic risk. An empire cannot stand for long if a small group at the top is sitting on a mountain of cash while the broad majority is buried in debt, stuck with stagnant wages, and convinced that the game is rigged. As frustration accumulates, politics becomes more extreme. Economic decisions become short-term, emotional, and reactive rather than strategic. That is the perfect environment for the kind of self-inflicted wounds that Buffett always warns chief executives to avoid at all costs. Short-term thinking, endless wars, and self-inflicted wounds. Buffett constantly reminds business leaders not to sacrifice the future just to make the short-term numbers look good. At the national level, however, the United States has often done the opposite. Instead of using its huge financial power to invest aggressively in infrastructure, education, science, and research, the country has burned through many trillions of dollars on long wars whose economic and strategic value is still heavily debated. A large part of those war costs was financed with government debt. That is exactly the same pile of obligations that today interest payments are being made on. At the same time, government interest costs have climbed steadily, taking up more and more space in the budget. If this were a company, Buffett would look at it and say that management has used leverage for too long to hide structural problems, and that sooner or later the balance sheet will strike back. On top of that, the way America has handled global trade in recent years has become more short-sighted. For many decades after the Second World War, the United States helped build an entire system of relatively open global trade with itself at the center. It benefited enormously from that role as architect of the rules. From Buffett's perspective, that system was a massive moat, a protective barrier built from legal frameworks, the dollar, and the deepest capital markets in the world. When the same United States turns around and starts threatening broad tariffs, tearing up trade agreements, and constantly changing the rules, investors and allies naturally begin to ask whether the system is still reliable. In a company, if the leadership writes the rules, then casually changes them and uses them as a weapon against both customers and suppliers, the intrinsic value of that business will erode even if the next quarterly report looks fine. While America has been wrestling with long wars, budget standoffs, and tariff fights, another rival has been quietly doing the thing that Buffett respects most. It has been reinvesting profits into long-term assets and building a durable moat for its future. That rival is China and its Belt and Road strategy. China as a geopolitical business that reinvests to build a moat. When Buffett analyzes a company, he always asks how retained earnings are being used. Are they being reinvested to expand the competitive advantage or simply used to polish short-term earnings? If we think of China as a geopolitical business, then over more than a decade, the country has followed a playbook that Buffett would recognize. It has reinvested on a massive scale into infrastructure, industry, and international influence. It has accepted that the immediate financial return on many of these projects may not be spectacular in exchange for stronger long-term position and dependence from partner countries. The Belt and Road Initiative is the clearest example. Hundreds of billions and together more than $1 trillion have gone into railways, ports, power plants, and key logistics routes across Asia, Africa, Europe, and Latin America. Dozens of countries are now linked by infrastructure that is built by Chinese companies, operated by Chinese contractors, and financed by Chinese capital. In Africa alone, China has financed and built thousands of miles of roads and railways, more than 20 ports, and dozens of power plants. Instead of exporting democracy by missile, China has exported concrete, steel, locomotives, and transformers. There are serious debates about debt traps and political influence. Even so, it is hard to deny a basic fact. In the eyes of many developing countries, China is the partner that brings something they can touch. Roads, electricity, bridges, ports. From a Buffett-style angle, this looks like an invest now, dominate later strategy. China accepts very long payback periods and moderate financial returns in exchange for a geopolitical moat that is extremely hard to tear down. Those rail lines, ports, and power plants will be there for decades, tying trade flows, resources, and political relationships to Beijing. By contrast, American efforts to build infrastructure abroad have been later and smaller. Instead of setting the agenda and drawing new maps, the United States has often had to react and try to block Chinese influence from Southeast Asia to Africa. Of course, Buffett would not casually say that China is guaranteed to win and America is guaranteed to lose. He understands that high growth does not automatically make shareholders rich. Issues of institutions, governance, transparency, and capital allocation remain large question marks in China. But he would also see very clearly the contrast between how the two powers have used their balance sheets. The United States has borrowed heavily to fund consumption, war, and short horizon policies. China has used domestic savings and trade surpluses to finance infrastructure and long supply chains. In history, the balance usually tilts over time toward the side that saves, reinvests, and builds durable moats. However, empires are not determined by capital and infrastructure alone. They also depend critically on institutions and the quality of leadership, which are always Buffett's first priorities. Weakening institutions and the quality of national leadership. In every deal, Buffett often says that he is buying management as much as he is buying assets. He can accept a temporary shock to profits, but he will not accept cheating, games with the rules, or a culture of distorted rewards. If we see the United States as a giant corporation, then its political system is its management team. And here more and more signs point toward undisciplined management, repeated budget deadlocks, threats to shut down the government, recurring debt ceiling crises, brutal partisan division, and a culture that values television drama more than actual solutions. From Buffett's perspective, the root problem is incentives. The current system of elections, media, and campaign financing rewards dramatic, extreme, attention-grabbing behavior. It does not reward the leaders who are willing to make difficult and painful choices that only pay off over decades, such as reforming pensions, health care, taxes, and spending. The result is a national management team that behaves like a chief executive who only cares about the stock price this quarter and ignores what happens 10 or 20 years from now. In business, Buffett despises that culture. He has publicly criticized cosmetic earnings games, the abuse of derivatives, and distorted accounting, calling some of those practices financial weapons of mass destruction. At the national level, he uses the phrase fiscal folly to describe a similar mindset: spend freely, fund it all with debt, and hope that the future somehow takes care of itself. The erosion of institutions, deadlock between parties, and a culture of politics as entertainment all slowly destroy the most important invisible asset of America: trust in the rules of the game. A business can survive for quite a while with weak management, but it cannot keep a high valuation once the market loses faith in its leaders. An empire is no different. Still, Buffett never tells ordinary people that the system is broken and they are helpless. On the contrary, he always stresses personal responsibility. Each person, he says, has to build a moat around their own financial life. What Buffett tells people to do when the empire shakes. The interesting thing is that even though Buffett sees many risks, he does not tell regular people to pull all their money out, buy gold, hoard canned food, or flee the country. His advice for most people has been remarkably consistent for decades. For the majority of investors, the best approach is to buy a low-cost index fund that follows the broad market, such as the S&P 500, and add to it regularly over time. Stay away from leverage. Stay away from products you do not understand. Avoid meme stocks, junk coins, and any get-rich-quick scheme. Keep your portfolio simple, low cost, and disciplined. In his will, he wrote that the money he leaves to his wife should be invested with 10% in short-term United States government bonds and 90% in a low-cost S&P 500 index fund. That is a very clear message. Even though he worries about debt, inflation, inequality, and politics, he still sees American capital markets as the best place for long-term wealth if you access them in the right way. So What can individual citizens and small investors actually do while living inside an empire that might be wobbling? First, do not panic at scary words like collapse. American history is full of wars, crises, inflation, and bubbles. Yet the long-term progress has still been extraordinary. The real issue is not whether the empire will ever shake. The issue is whether you will be wiped out because of your own debt, speculation, or lack of discipline. Second, clean up bad personal debt. Make it a priority to pay down credit card balances, consumer loans, and other high-interest obligations. In any serious downturn, those debts are the ropes that choke you first. Third, build the core of your portfolio with durable assets such as broad market index funds and the S&P 500, with maybe some diversification outside the United States. Avoid complex structures that you cannot explain clearly in your own words. Fourth, prepare emotionally to live through big swings. A drop of 30 to 50% in portfolio value during a crisis is not impossible. The key is not to smash your entire strategy in fear. Buffett became rich not because he avoided every drop, but because he never panicked at the bottom and always had cash ready to buy when others were terrified. Even if individuals protect themselves well, an empire can still weaken if its structural mistakes are never fixed. That leads to the final question. Does Buffett believe that the United States can correct itself in time, collapse, or renewal? In his recent letters, Buffett still repeats the line, "Do not bet against America." He believes that with its foundation of innovation, entrepreneurship, legal protections, and capital markets, the United States can keep leading the world for many decades. But unlike in the past, that optimistic message now comes wrapped in many warnings. Warnings about gigantic public debt, fiscal folly, financial frauds, rising inequality, and the easy optimism of crowds who think that nothing truly bad can happen. If we use investing language to describe America today, we can draw two main scenarios. In the bad scenario, the United States keeps delaying the hard work of dealing with its debt. It uses inflation and money printing to water down obligations. Inequality grows, institutions weaken, and politics becomes more extreme. In that model, the long-term intrinsic value of the American enterprise falls over time, even if current earnings still look impressive. In the better scenario, America takes advantage of its still very strong position. The country still accounts for a huge share of global stock market value and remains the main safe haven for capital. It uses that strength to rebuild itself. It gets more disciplined about fiscal policy, reforms the tax code to be fairer in ways that Buffett himself has supported, cuts wasteful war spending and politically motivated subsidies, and focuses again on investing in people and infrastructure. Buffett does not claim to know which scenario will win. He only reminds us of one cold truth. Mathematics and compound interest make no exceptions for any empire. You can delay the bill, but you cannot avoid it forever. So what is the real message you can take from Warren Buffett for this video? Warren Buffett still bets on America, but he no longer bets blindly. He clearly sees the forces that could bring down the American empire: runaway public debt, rising inequality, the loss of a strong production base, weakening institutions, and poor strategic responses to the rise of China. The future depends on whether the United States has the courage to face its problems and fix them, or whether it keeps sliding down the same slope. For each of us, the Buffett mindset is simple. Do not bet against America, but also do not bet your entire life on the idea that America will always rescue you. Take responsibility for yourself, clear bad debt, invest for the long term, own real assets, and build a strong financial moat around your family.